What is up, and welcome back to the best commercial real estate podcast in Jinx, Oklahoma. That's fact. It's facts.
It's fact.
What episode are we on? We know. 150. Ooh, 151. I like that.
Man, we didn't even do anything special for 150. I blame Tanner.
It actually is Tanner's fault. That's great.
Thank you, gallery.
Yeah, so 151 episodes of talking about commercial real estate. Anyway, we've had fun.
That's a lot.
Yeah.
So, exciting topic today, but before we get into that, we're just going to do a quick update. So, earlier this week, we closed on the Dawson Petromax gas station.
You.
Woo-hoo. Super excited about all of the investors who got involved in that one. Raised $1.7 million, injected into that deal. We think we'll hold. Honestly, I think the asset will sell before the end of the year, just with bonus depreciation and how much you can write off. You can write off 60% of this building, even if you buy it on the last day of the year.
Yep.
So super exciting there. We also are going to buy 4 more of these Petromax stations. Gas stations. So we'll send that offering out here in the next month to 45 days, I would imagine. We're currently looking for a lender now. As soon as we lock that up, we'll...
Equity raise will be bigger, $3 million.
Yeah.
On the package of 4.
Yeah, very similar return profile, if not a little better. So be on the lookout for that. And then also next week, we are closing our Martindale shopping center in Amarillo, Texas. We've been fundraising that one for weeks. It's been full for a week and a half. So yeah, if you're involved in that one, we start making money next Friday. Woo!
And we've got more deals coming down the line.
Exactly.
That we're working on. So
yeah, and
nice little pipeline.
Existing deals, right? We've been getting the push from investors for 18 months now. We're the shopping centers, guys. And
yeah, all of a sudden
we got them.
we got them.
So if you want to get invested in a cash flowing shopping center that already exists, hit us up. We have them. We also still have some room in the St. Louis deal if you want to win in that one. But anyway, a lot going on. We bought a piece of land at 121st and Sheridan. Did we talk about that last week?
We might have mentioned that, I
we
think.
did.
Yeah.
I think we did.
I'm excited about
So
that.
if you have any ideas about what should go to 121st and Sheridan, hit us up, man. We
Tulsa
haven't decided yet what we're doing.
If they're a bad idea, send them to Joel.
No bad ideas.
I'll take the good ideas.
No bad ideas.
Like IKEA.
Well, now that's a bad idea.
We've already had one idea.
There's one.
Here we go. Okay, so next, right? We've got a super exciting show today. We're kind of just going to go into what we think the current market looks like. Some market trends, some market forecasts. We're just over halfway through the year. What's going on?
Yeah. So why are we all of a sudden buying more shopping centers? 6 months ago, 9 months ago, we had no shopping centers. We weren't buying anything. We were doing development for the prior 12 months before that. So what market trends have occurred that are causing us to be able to buy shopping centers now?
Great question.
Yeah.
Interest rates haven't changed?
Yeah,
Really?
they haven't yet. And that's kind of essentially why we're finally buying shopping centers. Initially we had these stupid low rates, 3, 4, 5%. And then all these 8 cap centers around the country that were pretty good location, pretty good demographics, and we were buying them up. We got 3 or 4 point spread on cap rate to interest rate, and that's how you make a lot of cash flow. And then all of a sudden, rates went from 4 to 7, 7.5, short-term rates all the way up to 8.5. And so really, in any cycle, you have to give owners time to adjust. They thought their property was worth $4 million, and then interest rates double, and they still want $4 million, but it doesn't make sense at $4 million anymore. Mm-hmm. But they're not just going to be like, okay, great, I'll just take $2.5 million and call it a day. No, that's not how this works. What you have to give it time for the cycle to run its course. Yeah. Eventually, some people are going to need to sell. And maybe they're older, they're wanting to retire. Maybe their loan's coming due. Maybe they just leased all this vacant space and now they have the value. And so they have these reasons to sell. And so then they start selling. And instead of an 8 cap, they're like, maybe an 8.5, maybe a 9. Yeah. And it starts to push values up across the country just because rates demand that cap rates go higher. Interest rates demand that cap rates go higher over time. So we had this confluence of all of these prices starting to go down, cap rates coming up. And we thought to ourselves, we think that the feds are done raising interest rates.
Don't speak for Brian over
Yeah,
there.
speak for me.
Yeah, I think potentially they're done, right? So we're at this frozen section here, and we didn't want to wait until they started lowering rates, because once they start lowering rates, we think that's going to start pushing asset values up again, because it'll bring cap rates down. We just want to get ahead of that curve. We want to say, hey, if there's no more long-term risk of rates shooting a lot higher, and the cap rates have adjusted enough where we can make sense, where we can get a 7% loan and buy at a 9 or a 10 cap and get that spread, why not buy now, and then when rates come down, our values will go up. That was our thinking.
Yeah, great explanation. Just a more simpler perspective, right? 2 years ago, the real estate we're buying was worth millions more, right? So people that have to sell now. And when your back is pushed up against the wall and you have to sell, you're offering a discount. Very real example. The property we just bought in St. Louis was owned by I don't know if it was a publicly traded REIT.
I believe it was.
A big REIT. And they have over 3,400 properties, and they have half a dozen or less that have more than one tenant. Mm-hmm. So it's just no longer in the investment profile that have multi-tenant retail. They're deciding to divest this year. You're going to divest in market conditions, right? So a couple years ago, that would have been easily 8 cap real estate, which would have driven the price up at least $1.5 million, $2 million, right mm-hmm. there. So just on a very basic level, we're getting it at a discount. And if you believe that interest rates will come down eventually and you can still grow these rents and keep your tenants, you're buying at a discount, and you can appreciate that discount as soon as the interest rates drop, right? Because if we ever get down, like say we're at 7.5% right now. If you get a 1 point drop on a $10 million loan, you're saving $100,000. You're making $100,000 more that year, right?
And to put it in perspective, if you put $2 million down on that real estate and you're getting $100,000 extra in cash flow, that improves your return by, 5%? Am I doing that right?
Yeah.
100,000 over $2 million. And so you can see it just for that example, every 1 point drop is a 5% increase in return on your invested capital.
So what you're talking about, it's not too unlike any other supply and demand. Is that right? You've got a bunch of sellers out there, but not a lot of buyers because the interest rates went up. So the sellers have to drop their prices to sell their property, right?
Yeah, and essentially what we're doing right now is right now we are making a little less cash flow on a lot of these assets until some sort of value add proposition comes in line. So like the St. Louis deal, we're doing that through spinning off the Chipotle and Panda pad. And we're able to return about a third of the equity we believe. And then just that basis reduction right there, we should be cash flowing great. If we get interest rate reductions, which aren't built into the returns at all, just because it's fictitious. We have no reason to believe when and if they're coming down, right? So if interest rates start to come down, then we take what we think is a good return, and it really starts to get nuts.
Yeah, and if they don't, we still have a good return.
Exactly. We don't have to have the interest rate. So I would put a lot of caution in investments that you're reviewing right now as a limited partner, right? Hey, here's this deal. We're going to get a 20% IRR. We're going to hold it for 5 years. It cash flows 5% a year. There's something going on there. Yeah. You know what I mean? Like, where's the money coming from? Oh, we're going to double all the tenants' rent, and then our interest rate's going to get cut in half.
No, I think it's important when you're buying today if the deal works today, you get a 5-year fixed interest rate. If the rate doesn't come down, fine. You're still making an acceptable return. It may not be ideal, but at least you're in the game and you're making returns for your investors instead of having the capital sit on the sideline for the next 5 years waiting on rates. Like, if we can get them a double-digit return, maybe 10% versus a 12% or a 13%, and with these higher interest rates, I believe the upside is larger on the deal that the rates are going to come down. The probability, I think the rates are going to come down versus go up from where we are right now. It's better, I think, that they come down. Yeah, that's my opinion. I can be wrong. You never know what world events are going to happen. But I bet in 2 years from now, I bet the rates are equal to or less than they are today.
Yeah, the chances of that are higher than
the alternative.
Than the alternative, yeah.
Yeah, and I mean, I think there's a lot of murmur going on. Are we going to get a rate cut in September right before the election? Is that possible? Is that the one quarter point rate cut we get this year? What will that do to the economy?
Because not much.
Well, the economy's doing great, right? And that's why we're not having to lower interest rates. So it may do a lot more just because everyone's being kind of stagnant. Like, what's going to happen if you start to tick and trend in the right direction? the economy's doing great.
I am worried that they're going to cut too quick. I mean,
hopefully they don't. I think that
even that's coming from someone that wants low interest rates, but we also can't have a runaway economy where things that shoot up must come down hard. And I would rather kind of stay on this steady trend where people know what to expect. I mean, the Dow and the S&P and the Russell were hitting literal all-time highs week after week right now. So I mean, how much more do we want to juice this thing? I think slow and steady, as people have time to adjust, so we don't get ahead of it. And then, if we do get too ahead of it, then they got to start raising interest rates again.
Yeah.
And that's going to be a really scary situation because we may not have control like we do now. Right now, I think inflation is under control. But if we get too ahead of the game, then it'll get out of control, and that's when rates are going to have to go even higher, and that's not what we want.
Yeah, so what scares me right now? I would say what would scare me right now is buying some like stupid low cap rate multifamily deal, going in with like a ridiculously high rate, maybe a negative leverage situation. You're going in with 1, 2, or 3 years of interest only, and you've got to get 10% annual rent growth a year. I think multifamily is starting to see a bit of a plateau in rent growth.
Yeah, it's a good question. We haven't talked about multifamily in a while. You know how it was just going up in value like crazy for a long time. Do you guys have a feel for the current conditions in multifamily? Is it plateaued a bit, or is it still still really hot?
I mean, in Dallas, for example, right? There's been so much supply still, and there's so much out there still that rent is starting to stagnate. They can't fill up the apartments fast enough. There's still so much new supply coming online.
Yeah, rumors in Dallas are there are owners now starting to struggle. I mean, the frenzy that happened in Dallas was 5 times what happened in Tulsa. People fighting over assets, with those low interest rates. And now people are saying, okay, I bought into this thing with a 3% floater. Now my rate's 7, and I don't know what to do.
So they had a floater, and they were banking on increased rents.
Yeah.
But now there's some empty units, so they can't increase.
Yeah.
Or they just didn't get the rent pop that they were thinking about, right? Yeah. So like you go in, you're borrowing 5% at a 5 cap deal. You've got equal leverage, and then you go invest a ton of money and you don't get a rent pop. You're making no money, and then you can't refinance that thing. You're selling for a big loss.
But in general, I would say Tulsa, we haven't seen multifamily take a dive. I would say we've seen prices kind of plateauing. And for a while, they were just shooting up, and I think we've kind of seen that level off now.
Same with rents, would you say?
Same with rents. Rents are, I mean, there's still increases. I think they're starting to slow. So that'll be important to see what happens going forward. But what I have seen is, the A-class stuff went up first, B-class, and I'm still seeing some C-class assets that I think should sell at like 40 or 50 a door that are like, they're asking 70 a door here in Tulsa.
Mm-hmm. I think just the barrier to entry is so low now that
that if you want any units, you can take these really old kind of shitty units, and you can get them for way less than A units, but still pretty high for Tulsa C-class. So I think Tulsa's still absorbing it. We're still seeing a little bit of rise in the lower income stuff, but the top end's kind of leveled off. I think Dallas is going to see top end prices come down if rates don't start adjusting. Mm-hmm. Over the next year, if you ask me, what I would see in a Dallas or in an LA or a Phoenix, multifamily deals are either going to stagnate or they're going to start coming down some until we see a rate adjustment.
Yeah, and that being said, right, I think once that rate adjustment starts to come in, the housing frenzy is going to be there again, right? Like if residential homes are probably going to pop another 10, 15, 20% just like they did because the affordability to buy a home is going to be there. And as a nation, we just haven't been able to build enough homes. So that's why these rents have been going through the roof. So I don't think you'll see rents soften when that happens. I think if anything, rents will go up with home values again, just because we've been at such a shortage in home building.
Yeah, I mean, you think about after COVID when rates shot up, but also construction costs. It was a literal double whammy. And I think that shut down a lot of multifamily development. And so you're right, we're going to have a shortage of units online that will like further support rents that have kind of really gone up a lot. Now they've kind of stagnated, but that upward pressure of, hey, there's not enough housing, population growth driving it. And so now, you see construction costs coming down, interest rates are still high, but the demand that's building up in the market is going to start to materialize here over the next 6 to 12 months.
I know Owasso, where I live, a 1-bedroom apartment is double now what it was 10 years ago when I moved into my first little apartment there.
I believe that over the last 10 years for sure. Well, what's the next topic?
Yeah, so we kind of got into a little bit, but just leveraging and funding. If you're doing deals right now and you're getting able to make them work, what is the thought process behind it? How are you putting it together to make sure you don't get screwed, right?
Yeah, what we've done both on Precision side and some on the Criterion side is we're still kind of opting out of institutional money where we have to lock in the interest rate for 10 years. We still see, 3 years from now, 5 years from now, rates that are demonstrably lower than they are today. And so I don't want to get a kind of an onerous loan that is 10-year fixed with a massive prepay penalty, because I just feel like I want that flexibility. When rates come down, two things are going to happen. First, I want the ability to refinance down to that lower rate. Or if rates come down, it's going to push up prices, push up sale values. And I want the flexibility to sell it.
And so you're saying that if you get a traditional loan or a loan from a bank, you don't have that payout as big of a...
Like a non-recourse defeasance, Lifeco, CMBS, something where...
Yeah, bank debt, the interest rates are basically similar. I think you can get lower, maybe a slightly lower interest rate from institutional like a Fannie Freddie. But the flexibility I get with the bank, I can pay it off or refinance it at any time. Yeah. And a 10-year, Fannie Freddie deal, I may get, instead of a 7 rate, I may get a 6 or 6.5. But I got to own that loan now. And even if I try to let someone assume it, it's going to hamper my purchase price. So for us, we're staying flexible right now because we're not sure exactly how the market's going to go. And we want to be able to sell or refi in the event rates come down.
Yeah, I think it's all about debt service coverage ratio right now. Obviously, your interest rate is a lot more expensive, so that debt service is a lot more expensive. So you just need to make sure your property covers, which is driving leverage down. So consistently, a couple years ago, we were going in at 80%. I think we did a deal or two at 85% when debt was stupid cheap. Like, that tells you how much you can leverage it up because it's so cheap. It still covers the debt.
Now we're doing 70, 75.
70, 75. I think Houston is 70, maybe even 65, which is insane. I didn't think we would do a deal like that. I mean, it's a $14 million deal, and we're putting in $5 million. Mm-hmm. So it's lower leverage, right? And in exchange, you're getting lower returns. So in my opinion, the thesis is you're buying at a discount. You're okay with the lower return because you feel like you're going to get that interest rate pop, or you're going to continue to push rents or whatever it is. A lot of the assets we're going in on now have a spinoff or an immediate value add opportunity, or we believe rents are just severely under market and we can just push them up so much that we can get the cash flow that way, right?
So let's talk about. We've talked about a little bit of multifamily retail. I think. Going through COVID, retail kind of became, the less desirable asset class. Yeah. I mean, office, way less desirable, retail slightly less desirable, and, multifamily self-storage kind of over here, kind of really positive, assets. And so what we see is that with construction prices high and interest rates high and retail kind of being this thing that people aren't quite sure about coming out of COVID, we saw a lot more fewer retail construction starts. Mm-hmm. And so we think that's actually buoying up the occupancy in retail that otherwise maybe would be straining. Most of our properties are 100% or really close to 100% occupied.
National occupancy is, I think, 95 across neighborhood retail
because
centers.
Nobody was building retail over the last. I wouldn't say nobody. I'm just talking in general. Less people were building retail over the last 3 to 4 years.
And the top retailers are still expanding. The top 25, the top 50 retailers are actively still expanding, opening up new stores in new markets.
We haven't seen the fall off there. Office is another one we can talk about. You can read the reports. The big cities, San Francisco, New York, Chicago, they're getting hit hard now, and it's going to get worse. Less people are going back to work, but also some of these leases that people, the offices are vacant, okay, but they had good leases with good companies, so they've been paying. Maybe it was a 10-year lease, 8-year lease. Well, COVID, we came out of COVID, 2 years ago, 3 years ago. So as these leases renew, people are going to be like, you know what, I want half the square footage, or I want 0 square footage. So I think office, especially in big cities, remains to be a problem.
It gets hammered.
I don't think that you have to shy away from like a very specific office building in like a submarket that has a story to it. I think you could probably do okay with a smaller office building. Maybe a good company, a good lease, and it's not so big that you could fill it. But in general, office is a tougher one for us, and we're not as active in looking for office because I just don't see an office boom, in the next 5 years. Like, multifamily, I think you're safe. I think there's
AI is getting so good that there's going to be more people needed to work in an office job, right? It makes total sense. It makes no sense, right? Like the people working office desk jobs is going down, right? Specifically in Tulsa, and then these big markets. I mean, every big primary market you go to, there's vacant office buildings.
Yeah, I mean, I'm not saying you can't make money, but it's something that you should proceed with caution, especially in a market that there's high vacancy, because there's just too many places for your current tenants to go, and it doesn't give you any leverage when you're trying to renew leases at increases. Where on our multifamily, on our retail, we have leverage. Like where, your retail business, let's say it's in South Tulsa, like where are you going to go? There's not a lot of vacancy. And are those vacant spaces even asking less than what we're asking? Mm-hmm. Like we have some leverage to say, you're going to move your whole business over $1 a square foot a year? No, there's nowhere to go. And that's what you want, is you want that high occupancy where you at least have some leverage to keep your tenants.
I think light industrial, like small bay light industrial, is got a lot of similarities to what we do in retail right now. A lot of the same principles, right? Very high occupancy, expiring rents, half to 50% less than new construction if it's even being delivered. And a lot of people aren't even building those small bay light industrial stuff. You're seeing big tilt up wall shit go up right now. So I think there's a big play for a small bay light industrial, just like retail. I think you're going to be left with a lot of $6, $7, $8 expiring rents, and you have a compelling case to go back to them for 10, 11, 12. That's a massive increase. That's huge.
So we're almost out of time, but so that was excellent coverage of the market. But I have one question that maybe our listeners and/or investors might have in all this. You said that nobody was building big industrial complexes over the last couple of years. But our listeners might say, well, hey, Criterion, I invested in some of your developments. How are our developments different than what you're talking about on some of this big retail development? Was it because we did single tenant development? We already had leases in place. I mean, I don't think we did any developments more than 4 tenant spaces or something like that. And we already had leases in hand, long-term leases in hand, right?
Yeah. Not only are people not really speccing dirt, but people are definitely not speccing buildings with construction costs hundreds and hundreds of dollars per square foot. The only reason we're developing things is because we know the market cap rate for a brand new Chipotle is what it is. You can dial that pretty damn close to what you think your exit is going to be. Your biggest variable is the time of when you're going to exit it. So I think the biggest frustration on the new retail developments right now is there's such a backlog of inventory kind of sitting on the market because interest rates are so high that it needs that catalyst. I mean, people forget that the buyers and owners of these assets are 1031 sellers, and they're not. Those things aren't selling. The big multifamily Class A assets in primary markets, your massive tilt up concrete industrial assets that are $50 million, right? That gets bifurcated down into 100 Chipotles and 100 Starbucks and 50 Kitty Academies or whatever it is. So I think, again, once you see that catalyst on the bigger assets and those things start to trade, it's all just going to funnel down into this stuff. So to answer your question, the reason we're developing now is just because it's pre-leased and we know it's going to cover the debt and be fine until it's sold, right?
Yeah, it's that guaranteed lease. When I was talking about new construction starts for retail, is more spec retail.
Yeah, right.
You used to see people put up these strip centers or power centers,
vacant.
And they were they're like, okay, I got 1 or 2 of the tenants, but I'll figure it out.
Oh, there's one a mile away.
And that's what I'm saying. Like, we're doing single tenant or 2 or 3 tenants, or we have the leases in hand with national tenants, and so we know we're going to get the rent. So it's not a spec building. Yeah. But in general, to close this out, guys, I want to talk real specifically about we're talking about our thoughts on national trends, our opinions, which don't mean much. We're here in Tulsa, Oklahoma, Jinx, Oklahoma. But what you should be able to deduce is that no matter what the market is doing, okay, if it's up or if it's down, there's going to be areas that are going the wrong direction. Population are leaving the areas. Tenants are leaving the area for whatever reason. And then there's going to be the new areas of growth, right? A suburb of Dallas that that is the new hot area, and a brand new Walmart Supercenter is going to go there, and retail is going to surround it, and there's going to be Chick-fil-A and Chipotle and all these things. Mm-hmm. So don't get caught up too much in the macro, because there's always a micro opportunity in a certain market, in a growth area, to make money in real estate. And so you just can't get discouraged by the market's not doing well overall. Well, that's true in some cases, but always look for your opportunities locally, because there's going to be some, and you in your city know where the growth is, where the hottest part of growth in your city is, and it's going to be way different from the worst part of growth in your city. Yeah. And so between those two are your opportunity.
All right.
Great thoughts. All righty, guys. Well, we will see you next week on how to invest in commercial real estate.
All right. Thanks, guys.